Hi everybody, this is Breeden of Insanity Industries, and today I'm going to dispel a myth of trading and investing in general, that of greater risk is equal to greater reward, and vice versa. To get a greater reward you must take greater risks. So when I was doing my undergraduate degree, this risk-reward paradigm was presented to us, and no proof of it was ever really forthcoming, apart from it being sort of logically obvious. And then they defined investing as the creation of positive net present value situations. And so investing didn't matter whether it was buying a new factory to increase your output, or buying stocks or bonds, or any process you did, as long as the end result increased your purchasing power in today's dollars. So this didn't quite sit right with me because I'd been trading for quite a while as I was doing this, and I'm going, that's not quite right. It took me a little while to put my finger on it, but here we go. So in my opinion, there are two types of investing. There is lending process and there is a trading process. So the lending process is where risk and reward are positively correlated. This is where you come to me with a business idea and I either loan you money or buy equity in your business, and from here I expect to get a return in the form of a dividend or of a a coupon rate or anything like that. So I get paid back in cash over time. And the riskier I think your business is and you are, the more I will ask for, so I can get my money back faster. So greater risk, greater reward, absolutely correlated in this state. However, the second type of investing is effectively trading, where you essentially buy goods with the expectation of selling them for more later. And this process is really quite different in that you don't make more by taking more risk, you make more by taking less risk. Now, to explain this, you sort of got to understand or come to the conclusion that risk is different depending on whether you use a lending process or a trading process. If I lend you money, risk is really about the probability you'll fail for whatever reason. And it doesn't matter whether it's you're a bad business manager, your idea is stupid and there's no market or anything like that. It's all about the probability of failure. However, when we trade, the process is different and risk is different. It's not about the probability that your trade doesn't work out. It's what's the worst possible thing that can happen when you buy a product and hope to sell it for later. And the worst possible thing that can happen to you is simply that you buy it and you can't ever offload it. And so we get this idea from here that risk has to do with the absolute downside of the trade, and it doesn't matter whether you're buying Apple stocks hoping they'll go up, or whether you are buying cans of baked beans hoping to sell them off like a supermarket does. The reward side of this equation has to do with the total amount that you could potentially get out of it. Now, up on screen now is a little supply and demand, stylized curve that every economist has ever seen. If you've done high school economics, you ran into this day one. And on this little chart, we've got the real price. That's why it says RP, the real price. I'm eliminating inflation from the equation just for the sake of simplicity at this point to get the idea across. And if the lowest real price that it had ever been was $2, and the highest real price that it had ever been was $12, and we bought it at $2, we might expect there to be possibility of $10 reward, because the price could get back up there again. and that's in real dollars, so it doesn't matter how long it takes. When it comes through, I will have so much more purchasing power than I had, because I've successfully made the trade. Now, as we rise the price, we still come across the probability, or the possibility I should say, that you can't offload it. So if we're now buying this good or this stock or whatever it is at now $3 for a unit, the possibility exists that we can't offload it, so the risk is now 3. There's more risk than before. And there is still some downside risk. It might be that price falls back to $2 and you get a partial loss, but the real risk we're taking is 3. But because the real risk we're taking is 3, we've bought it at 3, the greatest price of all time is still only 12. So the reward now comes down. Now if price comes up to the line there marked PE, which is expected price of $6, potentially you could make 6 more if it got up to 12. Potentially you could lose some, but at the worst you could lose $6. And as we come up towards 10 and then to 12, you see that the risk goes up and up and up and up, and the reward goes down and down and down. Now there's also probability going on here, that with the expected price is above the price you buy it, you're more likely to be able to sell it for more. And when price gets above the expected price, you are less likely to be able to sell it for more. So now we're going to have a look at what this means on a real chart, because this, as I said when I was doing my undergraduate degree, these theories would be presented and no one would ever produce a price chart to back up their theory. And here we have a price chart of GU. It's a weekly chart, it's all big, it's all good, and we will now begin to mark up a section. And so this down here, of course, is our fat finger event that most of our traders will remember. And we can go on and we can see that after that it comes past this pivot and goes into a ranging period in here. So we can see that this is just like the diagram I drew up before, which if I just sort of mark up here, basically goes like this. So there's the same diagram happening, with our expected price somewhere in the middle, of which we get this nice little averaging pivot here. And we can see the effect of the supply-demand curve and the expected price, and the highest it's ever been, the lowest it's ever been, affecting how this goes. So what this means as a trader is, I mean, dare I say, it's obvious. I want to buy at the lowest price and I want to be able to sell at the highest price. So from this, we can extrapolate where the greatest amount of risk is on the reward. The greatest risk when you buy and the greatest risk when you sell. So if I was to buy, clearly any purchases up here would carry a huge amount of risk and very little upside. And trades that we could take out of here would carry a lot less risk and would have a lot greater upside. And similarly, if we were to go short, there's a lot less risk if we can sell up here, and a lot greater profit if we can offload it down here somewhere. So here is the practical demonstration of the theory that I just covered, showing you that the price chart conforms to the idea that risk and reward are inversely correlated when you trade, not positively correlated as they are when you do traditional type investments, and that we can then take this onto a price chart and go looking for places of low risk to make a trade, which is pretty much the point of what we want to do. We want to trade with the least risk and the most possible reward. So this has been Breeden of Insanity Industries, helping you make more by sucking less.